In the 1600s, the Dutch East India Company sent ships around the world to trade spices, porcelain, silk, and other valuable goods. Those voyages could produce enormous profits, but they were expensive, dangerous, and too large for a few merchants to finance alone. So, the company collected money from private citizens. In return, investors received shares representing ownership in the entire business. Unlike earlier one-voyage arrangements, these shares could remain invested and be sold to someone else without dissolving the company. Trading gathered in Amsterdam, where the Dutch East India Company became central to what is widely considered the first modern stock exchange. 4 centuries later, the machinery is faster and more complex, but the basic bargain remains. Companies receive capital, investors receive ownership. To see how that bargain works today, follow Harbor Coffee, a fictional company that wants $10 million to build new roasting facilities. Harbor hires investment banks, called underwriters. They help prepare disclosures, estimate demand, set an offering price, and find initial buyers. Through its initial public offering, or IPO, Harbor sells 1 million new shares at $10 each, raising $10 million before costs. This sale happens in the primary market, where newly issued securities are sold and the issuing company receives the proceeds. Each share represents a small ownership claim. Shareholders may gain from rising prices, possible dividends, and sometimes voting rights. But after the IPO, something changes. Harbor's shares begin trading on an exchange between investors who want to buy or sell. That is the secondary market. When Sam buys 10 shares for $12 each, his $120 usually goes to another investor. Harbor does not receive Sam's purchase money. This is the part many people miss when they hear that buying stock funds companies. The IPO funded Harbor directly. Later trading gives existing owners liquidity, meaning they can convert shares into cash by finding buyers. A higher share price can still help Harbor indirectly, including when it later issues shares, uses stock in deals, or compensates employees. So, what moves the price? At any moment, buyers compete with sellers, and the newest agreed trade becomes the market price. Suppose Harbor reports growing sales, and investors expect larger future profits. More buyers may accept higher prices to secure available shares. Now suppose coffee costs surge, or management cuts its forecast. Buyers may offer less, while worried owners become more willing to sell. The price falls until buyers and sellers agree again. It is not an official score, but a constantly updated collective estimate. If Harbor has 1 million shares trading at $15, its market capitalization is $15 million. Price multiplied by outstanding shares. If the price drops to $8, market capitalization becomes $8 million. $7 million did not leave Harbor's bank account. Sam paid $120. At $15 per share, his stake is worth $150, a $30 unrealized gain. At $8 per share, it is worth $80, a $40 unrealized loss. Either result becomes realized if Sam sells. Daily prices absorb changing expectations about profits, competition, interest rates, technology, leadership, regulation, and the wider economy. Confidence can move faster than business results, sometimes too far in either direction. A market price is an expectation, not a guarantee. Short-term noise can therefore hide the underlying business. Yet, price still matters because it determines what current owners can receive today. Owning only Harbour ties, Sam's outcome to one company. A diversified fund spreads money across many holdings, reducing company-specific risk, not eliminating loss. That is the stock market's central function, connecting companies seeking long-term capital with investors willing to own uncertain future results. The first step is understanding what you actually own. The next is learning how index funds bundle hundreds of those ownership pieces together.